the day because we always rack his brains on auto way too much. Let's welcome Abhiram Eleswarapu, who is the head of India equity at BNP Paribas, joining us now. Abhiram, 7 days of a rally on the Nifty. We can call it a rally and 7 days mainly because of the underperformance that we've suffered for months before that. Do you feel any more optimistic, or is your mood still, indecisive?
Thank you for having me. Yeah, I think we've generally turned a bit more constructive. If you recall, in the previous few times that I was here, I was kind of highlighting the risks to valuations and earnings and so on and so forth. But if you see year to date, India has underperformed most global markets by 10 to 15%, if not more in some cases. And if you stretch that back to, let's say, last September, compared to, say, China, we've underperformed quite significantly. So this period of both price and time correction has lasted quite a bit. And now when you compare this with where bond yields are, for example, the scenario for equities has become slightly better. So if we take a kind of a 12-month view, our Nifty target is 19,250. So that suggests a high single-digit upside from here. Broadly, we've turned a little more positive over the past month or so.
Abhiram, we've been chatting now for so many years on IT particularly, and you've been closely tracking that sector. And your view is that markets are being too bearish about the outlook for IT. And I remember this is what we had spoken about last time as well on air. Can you take us through your thesis going into IT earnings now?
So we're still positive. In fact, very recently, our analysts also put out a report talking about how IT demand tends to track nominal GDP growth. And therefore, during inflationary periods, actually demand for IT holds up quite well. And if you look at what the peers, global peers are saying and the guidance they've given, it does suggest that demand is certainly not collapsing. Now, all that said, IT managements typically tend to be cautious at the start of the year because there are so many unknowns that they have to factor into their outlooks and guidance and so on and so forth. So in the forthcoming earnings season, I wouldn't be surprised if the numbers may be okay, but the outlook for next year, while the commentary may be strong, the numbers given in terms of guidance may be a little bit disappointing. But I would think that will not change the 12-month or 3-year view on the sector, and we'll broadly still remain positive. It also so happens that when demand is somewhat not as good as, say, last year or the year before, large caps tend to have a slightly better positioning compared to the mid and small caps.
You're saying that if the guidance is disappointing, it's on account of the management's being conservative, and therefore the best approach is overlook the management commentary, and if there is a dip, go ahead and buy it? Buy the stocks?
Yeah, at the end of the day, management speak what they see today, right? But most of the lateral data points or indicators that we have been tracking suggest that demand is not going to fall off as much as investors believe. So yes, I tend to agree with your view. We're still constructive. If there is a significant correction, we'd actually be buyers into that.
Okay, so you're looking to buy IT. Abhiram, hi, good afternoon. You all said that you're beginning to get a little more constructive on the market in the last 1 month. So what else apart from IT would you like?
So for us, financials remain kind of evergreen. We still like financials, especially the large banks. We've been positive on private banks, but of late, we've also started to get a little more constructive, a little lower on the quality curve, if one could call it that. And therefore, the below prime segments are also looking interesting. I mean, all this stems from the fact that risk appetite for companies is starting to increase. Balance sheets are still reasonably strong. The asset quality is still holding up rather well. So we think growth will be still okay. And at the margin, it's likely that the growth will broaden beyond just the largest banks. So I think I'd be kind of looking at a broader spectrum in financials to invest. And furthermore, insurance companies have taken a bit of a beating in the past few months. But of late, we've been kind of looking at the data a bit more in depth, and we start to think that maybe that's a bit overdone. And in fact, across financials, if there is one area we are most positive on today, is actually insurance.
Abhiram, just wanted your thoughts on the pharmaceutical and healthcare space, because I remember you being constructive in the specialty pharma space. At the same time, you said that you hold all your positions in healthcare. That's doing you well. I mean, this month it's been one of the best performing sectors. Have you increased your positions there, or you continue to hold on?
By and large, the view is unchanged because when we do give out these views, they tend to be a little longer term in nature. So it's largely unchanged. We still like specialty pharma and domestic oriented businesses. But where we are incrementally more positive, and I think I briefly highlighted this last time when we spoke, is the diagnostic space. Firstly, we think that competitive intensity is decreasing. And also companies may have a bit more pricing power than the market believes. So over the next few months or so, you may start to see the larger labs start to increase prices just a little bit, at least to hedge themselves against inflation. And that may start to shield their earnings a bit more. Valuations have corrected quite a bit. And I think that space is looking particularly exciting within the overall healthcare space.
Okay. Abhiram, let's just snap out and talk about the market as a whole. I mean, we've been going through this time correction, consolidation, call it what you want, for many months now. Do you anticipate that this is going to be a sign of things to come as well? Do you see some sort of a overall broader market move?
Well, I'm actually struggling to create a 12-month single line move in the index for the rest of the year. Because if you come to think of it, there are two major risks emerging. One is whether central banks have indeed beaten the inflation game, whether they've won the battle or not. Because I think, if you look at least in global markets outside of India, investors are starting to expect rate cuts by the end of the year. And I wonder whether that will really happen or not. I have a feeling that inflation is a bit more sticky than people think. Rate hikes may have come to an end, maybe one more rate hike by the Fed in May, but after that, that may pause. But I'm not sure there'll be rate cuts that the market is thinking. The second element is, and you can see that with a lot of data, especially around the PMIs and so on globally, growth is indeed starting to fall off. We may avoid a recession or maybe just have a mild recession in the US and Europe. But the question is whether that will start to impact earnings as well. At the start of the year, we did think that it will impact earnings. And we still hold that view. So these two risks have to be taken into account. Valuations today are not expensive, but by no means are they very cheap either. So if I were to kind of think of a one-line summary of what I just said, it's likely that we will have choppy markets the rest of the year, but we may end this year with high single-digit returns on the Nifty.
I think people will take that with both hands, considering we've had a bit of a downer last year as well, and this year at least the start hasn't been too optimistic. Abhiram, just finally, before we let you go, wanted to get your sense on the big debate on the consumer. Right, there's one narrative that the lower end of consumption is where the hurt is happening, high interest rates, and perhaps more susceptible to any sort of stickiness in inflation, monsoon, so on and so forth. So, what's your call? Discretionary versus staples? Do you like either or both? Neither?
Actually, we are highly selective in consumer staples. In fact, the consumer space as a whole. And I think all the points that you mentioned hold true. In fact, we think this quarter will be rather good for consumer staples companies because they'll probably have the tailwind of price increases as well as some RM cost benefit. But we think that both these tailwinds may start to go away in the next few quarters. And while the monsoon may be normal, there is always the debate around whether that will indeed change the consumption patterns a whole lot. We think not. So overall, consumer staples is not the most exciting space for us at the moment. I think where we're starting to pay a little more attention to is on the consumer durable space, especially some parts of, let's say, air conditioning manufacturers and so on and so forth, where valuations have corrected. Of course, you've had some unseasonal rains at the start of the last month or so. But maybe beyond that, as the summer starts to pick up, maybe sales will start to improve and investors start to pay attention more to the valuations that have corrected and probably earnings cuts stop at that point. And I think that space is looking a little more interesting to me.
Okay, so you're watching for the consumer durable space and waiting for the earnings downgrades to stop up there. Abhiram, thank you very much for joining in. We'll chat with you as the earnings season progresses. By the way, Titan is a stock which has suddenly spiked up. Sharp up move in the last 10 minutes. It's now up close to about 0.3%. Big surge on good